We continue to see the gyrations in global bond markets. This chart on the Bloomberg just showing how Italy spreads continue to widen. We had that sharply higher fiscal deficit projection being confirmed, and really we're seeing that driving European yields higher as well. The pressure on global equities because of this is immense.
Enormous. And I know we love to talk stocks just because it's companies that we can relate to more easily than more theoretical bonds. But this really does have a huge impact. And I like to describe it as, why would I take the risk of this stock that's going up and down and all over the place when I can get a guaranteed 5% in a 2-year bond? That safety, risk-off type of mentality, where investors that for decades really just wanted to be 100% equities. They didn't even want to talk about your bond allocation, not until well into retirement, are actually looking at them as real value and real options. And obviously with the advent of bond ETFs, even as someone who doesn't want to invest directly into a bond, there's certainly a lot of options and easy ways to trade it. So we talk about equity risk premium, so how attractive equities are compared to a risk-free rate like a bond. And when these bond yields are becoming so high, it really is much harder to justify being in some of these riskier equities.
If you had to justify it, where would you stay in the equity space, though?
So right now, even though we're very oversold and there's a lot of negative sentiment across the world globally, I'm still overweight in U.S. large caps, particularly more of a tilt within value, just because anything growth, anything that's more forward or in the future, those profits are less valuable with these higher interest rates. And again, also we're just, seasonality, September is a bad month, we're just a little oversold. I'd say I don't think it's quite time for that shift where you're going to take on riskier assets or jump into European stocks just yet, even though those stocks certainly from a valuation standpoint look more attractive. They just have a few more headwinds where I don't think it's quite time for their outperformance just yet.
Yeah, Erin, you mentioned September being a bad month. We too, in fact, have a chart that illustrates just how bad. The S&P heading for one of its worst months of the year at the moment. And we're also heading into the final trading day of the quarter. How challenging have you found this quarter, and what are your expectations for the final quarter of the year?
Well, I'm certainly hopeful that it will be better. This has been a very challenging month. And this is seasonality, but it also has I'm assuming that basically Treasury rates will stabilize. We've seen a massive jump just in the past week and 2 weeks. And so assuming that we do get a little more confidence around the Fed, maybe less hawkishness statements, that will help the equity market stabilize and therefore hopefully not see some of these negative returns, even if they were just slightly flat. Would be more beneficial. But I think it's going to take, given that we've had such a big jump in Treasury yields and crossing over 4.5% on the 10-year, it's going to take a couple weeks to pan out. So I think the beginning of October could continue to see some volatility, some negative days before we really see investors reset their minds about how much I'm willing to pay for stocks, what type of premiums and what valuations I'm willing to pay, and before we can get back into that trading market.
In terms of the Fed, we did hear from Thomas Barkin a little bit earlier there saying it's too early to say if they need to tighten again. And in terms of potentially one more hike, does it actually need to happen, or is just saying that it might happen going to be enough?
I think saying that it might happen is enough. I think any of these hawkish announcements are enough to shake investors. Clearly, we're very much in a risk-off sentiment, and we know that the buyers are on the sidelines. I think we need to see some sort of positive outcomes. We've seen a lot of negative economic news recently between higher oil prices, inflation, low, housing starts, those type of things. So it really just could be generated simply by lower oil prices where the consumer feels stronger, and that could help change sentiment. I think that's another big important part of it as well, is that we're getting hit with these higher yields and obviously higher oil prices.